Erin, what do you see in terms of the movements that we are witnessing in equities? As I said, the seventh straight day of rallies. We're well up over 4,100 on the S&P 500 in the cash trade, and rates are singing a different story.
I think that's right. I think both rates and equities are singing from different hymn books at this point, where you see rates now really pricing in an accelerated move of cuts starting in the second half of this year and into 2024, which tells you that the rates market is starting to price in that we're heading towards a recession. Equities, however, still are priced for very rich valuations, continued growth and expansion this year, and even more so in 2024. And are really not focused on the fact that, that we're heading to a recession. So I don't think both markets can be right at the same time. Either we're not heading into a recession and rates need to reprice higher, or we are, and equities are really primed for too much growth and are going to have to re-rate lower.
Erin, are you concerned about the banking issue? Are we not done with it? Is it not in our rearview mirror yet?
I don't think it's in a rearview mirror. Certainly the immediacy of the sort of heightened period of fear is behind us, but I do think we're going to have more drips of this as we move through the rest of this year. Given the amount of extreme, and the rapidity of extreme tightening that we saw last year, I think there's a lot of, sort of hidden risks under the surface, which are going to come to a bubble as we start to see more time proceed and as we head closer and closer to recession. So I don't think we're going to see the scale of another failure like Silicon Valley Bank, but certainly the risks are not behind us. We're just, I think, at the beginning, really at the beginning point of seeing what emerges from some of the cracks from the extreme tightening that preceded us last year.